Let's touch base with Mark Mobius, an important global voice. Executive Chairman, Templeton Emerging Market Group, joins us on the show right now. Mark, it's great to have you on the show. First up, what's your outlook on emerging markets at this point, especially on India and China, given all the macro risks?
The outlook is very good for three main reasons. First of all, the growth rate of these countries is excellent, including India. Despite all the problems that you've been hearing about India, the fact remains that the economy is growing at a very good pace. And that's also true for emerging markets generally. This year we're expecting an average of 5% growth in emerging markets versus less than 1% for the developed countries. Second point is that foreign reserves in emerging markets have been building up so that they're now much, much higher than the developed countries. And the third point is that the debt levels of emerging markets is much lower in terms of the ratio of debt to GDP. So emerging markets are looking very good.
Right. Mark, how worried are you about China right now, given all the talk about bubble risk there and the central bank actually moving on cutting rates?
No, I don't think there is going to be a hard landing. In fact, I don't think there's going to be a landing at all, simply because the most pessimistic forecasts look at 6% growth for China. The government is targeted 7.5%, and we believe it's going to be higher than that. Usually the government is more conservative in their estimates. So we're talking about 8% growth for China, which is very, very high growth.
What's your call for equities for the second half of the year, Mark? Do you think that the valuations might restrict major downside from here on? And can emerging markets outperform despite the turmoil in Eurozone?
From what we see in terms of valuations, they are very low. The average for emerging markets now is about 10 times price-earnings ratio, which is, by historical standards, quite low. So we think we are at the bottom of the range, and therefore lots of opportunities for investors. And nobody can predict where the market is going to be a year from now, but we are certainly buying and holding what we have.
Can growth in India, Mark, be revived despite the central bank not easing rates? Also on the policy front, not much is being done in terms of taking steps to encourage capital investment or to improve India Inc. sentiment.
I believe that the economy still can grow despite the fact that interest rates do not come down for a number of reasons. First of all, we've noticed that at the state level there is a lot of activity. There are a number of states that have instituted reforms to assist business and to encourage investment. And that is going to drive a lot of what's going on in India. So we don't have to focus only on New Delhi, but look at the individual states, what they're doing. For example, in our organization, we continue to have a very large complement of people, over 2,000 people working in Hyderabad for us. So we believe there's going to be continued growth.
What about India in particular, Mark? And what do you think can turn the sentiment positive for India?
The key factor is predictability. The business community, investors, both domestic and foreign, have got to know what the government plan is and whether the government is going to institute that plan, so they in turn can make plans for their future. It's no good to have a change in tax policy and then a change back to another policy, because this creates a lot of uncertainty, and business hates uncertainty. They don't want to invest if they are uncertain.
Right. Are you looking at deploying your cash in equities at this point in time, Mark? Should panic in markets be used to really pick value stocks?
Yes, definitely. Given the fact that money supply globally has increased so dramatically, investment in equities is very important because it's a way to protect against inflation. So we believe that it's now a good time to put money into equities.
What sectors, Mark? What sectors or what stocks, if you can name, that you're bullish on at the moment?
In India, we of course continue to like the software data sector. That's been doing quite well. There have been some setbacks with a slowdown in Europe and the US. But these companies are global now, so they can go in many, many areas of the world where there is growth. So that's one area. The other area is the natural resources sector. We believe that there are lots of untapped natural resources in India, and of course the Indian government eventually will want to get those natural resources exploited. So that would be another area. And then the third would be consumer. We like the consumer story in India. It's a young population that's growing. Per capita incomes are growing, and therefore we want to be exposed to that sector.
Right, but which sectors, particularly in India at this point in time, are looking overheated, especially given the talk and the kind of focus that there has been on consumption?
No, I don't see any areas that are terribly overheated, although in the consumer arena there are some companies that are rather expensive and that we wouldn't want to buy at this stage of the game. But generally speaking, the valuations are not too bad.
Okay, and the other bit, Mark, that I wanted to ask you is, what's your expectation, or what are your expectations from the Fed? Do you expect to see easing, and can this easing lead to commodities again hardening, which of course doesn't augur too well for the emerging markets?
I see continued easing. Now, whether they call it QE3, QE4, or whatever, the fact remains that the central bank, Bernanke, is convinced that he's got to continue to stimulate the economy to ensure that there is not the same kind of problems that occurred during the 1930s.